Hello, and welcome back to the Wall Facer podcast. Today's guest is Luca Prosperi, the CEO and co-founder of M0 Labs. M0 is building stablecoin infrastructure for the next generation of finance. Luca is also the author of the popular Dirt Road Substack. Luca, welcome to the show.
Thanks for having me, Ryan. Always a pleasure.
My pleasure. Likewise, always good to chat, and we don't get to do it enough, but one of the things podcasts are great for. So in prepping for this conversation, I went back and read a bunch of your original Dirt Roads issues, which is your popular Substack that I'm sure most people will know. And in your first issue from 2021, you highlighted the 15 years of experience you had working with financial institutions before having this, strong belief that banking was about to undergo this radical change, the biggest you've seen in your lifetime. A lot of that was obviously crypto related. And I'm curious what the first crypto pill moment or kind of changes that you saw around that time that, got you to start writing Dirt Roads and then move into crypto full time.
Yeah, I mean, the answer to this question has two components. I'll get the personal one first and then go to the business one. I think the personal one, some of the people who know me, I've been always very public about this, know that I had in hindsight, I think, lucky experience of surviving cancer. So for 6 months, I had to step out from work and take a lot of time to cure myself and in isolation. So I had a lot of free time to think about what I wanted to do with my life and what was going on in the outside world. And that's when I started to check what was going on as part of the DeFi summer back in the day. And so I had a lot of time to think, and my time was very valuable to me. And I think this was one of the most powerful catalysts for me to become a researcher and then an entrepreneur. I would always feel privileged to have gone through successfully such an experience. Obviously, I'm making a very complex story easy. But on the other side, I think my red pill was probably, as part of my research endeavors, the discovery of the MakerDAO project. Back in the day, MakerDAO was one of the granddaddies, still is, of DeFi. And I think in its basic first iteration, it was extremely fascinating to me. Probably they didn't even know, I think, the Maker funding team, that they were actually reinventing money. But that's what I did in the process. I think that money in its simplest form, and I always joke that money is the most complicated, mass adopted product there is. Money is a liability. Like what you see when you see a bank deposit, it is a liability of a bank. The bank is telling you can trust, I can give you the money back because I have enough assets to back it up. This is ultimately atomically what Maker was doing. You can trust that if you have to get your money, that there are more assets than DAI flowing around. And on the other side, it was a good way for asset holders actually to finance, to get a loan in DAI form. So I think it was a very elegant way of reinventing money through on-chain interactions. And I think that was the beginning. I started to participate into that project. And then I tried to connect the MakerDAO project with the real world that was actually existing outside of blockchain. That's actually how we met many years back. And I think everything started from there.
Yeah. I think one of the things I appreciate, and I think probably so many other people appreciate about your writing, and which you demonstrated in that answer, is that, you obviously do have a great technical understanding of all these things, but I think you're also able to really wrap in this sort of philosophical element to our industry. And also you have a lot of great prose too. But when you're talking there about kind of this philosophical aspect of money and what it is, you mentioned that you see money as this kind of form of debt, kind of a maybe big and impossible to answer question, but like, what is money to you, and how has the systems you've seen and are now building in crypto maybe changed how you think about money?
Yeah, I joke also, I think I wrote about this in Dirt Roads, that when I used to be an investment banker and an investor, but when I was an investment banker, most people think that bankers understand banking. Bankers do not understand banking. Most bankers understand the industries they serve. So if you talk to a telecom banker, they understand telecom companies very well. But then there is a subset of bankers that are so-called bankers, financial institutions bankers, that are serving other financial institutions. They understand financial intermediation very, very well, and they are despised by the rest of the world. I think every large investment bank has a floor with fake bankers locked in it. It's the largest team. Nobody knows what these guys are doing, and vice versa. So the way money works in banks, because banks are the main printers of money nowadays, it's very opaque to the outside world. And most of the outside people come from the payment industry, and they just take this building block that has been manufactured by someone and they use it to do stuff, and they give it for granted. They say, okay, yeah, this is $1. It's good enough. And I think this is the secret of money market instruments. You can also ignore how they're manufactured because they kind of work. But in reality, money in digital form, as we know it today, as printed by commercial banks mostly, are some sort of liability that where the value is based on a very complex balance and equilibrium of controls and buffers. So a bank has, I don't know, $1 billion of deposits. Behind that, there are $1 billion+ of assets, plus a lot of risks that you can observe or not observe, a lot of rules how to manage those risks, a lot of oversight from regulators to make sure they manage those risks effectively. So there is a very complex stack of checks and balances behind this dollar. And the commercial banks until now have managed most of those checks and balances in a very, very convoluted and complex way, to the point that sometimes they blow up. And in hindsight, we try to understand why they blew up, because not even the CEOs of these banks know exactly what type of risks they're having. They're very complicated animals. And I think the beauty of crypto in general and DeFi, that is one of the phenomena that emerge in the crypto industry, is that you can actually observe and compose risk creation in a way more efficient way. So I think we are very in the early innings of reinventing this big monolith that banks are through a set of protocols that interact with each other. And to me, it's extremely fascinating because if you think about it, the financial industry is the last one that hasn't undergone a big radical evolutionary change based on technology. So for me, it's super fascinating. So like I've always considered myself a system designer, and I think being a researcher is very important because what I'm trying to understand is what is the best way to design the system that creates money and value flow for the future. And I'm not really interested in pump and dump or big hype, because in my opinion, this sector is so massive, is so huge that if you do good work that leads to sustainable growth, we can really, this, even if you look at the stablecoin market, which is $200 billion today, and there are people already crowning winners, I think it can go 1,000x over the next 20 years.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built Vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback.
A lot of jumping off points there, but I want to come back to something you said a little bit earlier about the role of commercial banks and people kind of not thinking much about the risk associated with their money. And I think I don't know if this was your term or not, but in the newsletter, you talk about NQA, the NQA-ness of money, no questions asked, kind of when you're holding things. And I feel like for me, and maybe a lot of people, in part being in crypto, in part, all of the community and regional bank stuff that we've seen over the last year or two, I'd say that a lot of people probably feel differently about even dollars or their bank account relationships today, where they are asking more questions. Do you think that there's kind of a broader unraveling of people's relationship with the no questions asked properties of money, and now we're always kind of skeptical and questioning, or am I over-indexing too much on us crypto people?
No, I think there is, but I also think it is cyclical. I think there are moments of stress and people start asking what is actually backing the dollars they think they have. I mean, there have been movies about it, and there is like there are cycles. So I don't think this. People are lazy in general. Humans are lazy. We are all lazy. I mean, we are. It's a good it's a prosaic way of saying that we are trying to minimize energy loss. So at some point when people get lazy, they go back just not caring, which is normal. But I think these moments of stress, they remind us that the current system we are on, it's probably not the most efficient one. And I think that, so it is quite clear, it has been clear for the last 10, 15 years, that the current system, post-Bretton Woods system, where all the economy is based on commercial banks that are storing the people's wealth and financing industries, is not the most efficient. They lost a lot on the side of on the lending side over the last decades, and now they are trying to hold very tightly their monopoly over the deposits. But this will change. And it's also a matter of power. Like if you think about it, like up to like 20, 30 years ago, you were interacting with your money 95% of the cases through a branch of a bank. Now you're interacting with your money through an app, a fintech app, an exchange. And so these guys have the power. And so these guys are starting to ask themselves, if I am Coinbase, why do I need to have, or Robinhood, why do I need to just leave most of the margin to like a set of commercial banks that are not doing any heavy lifting? They're just regulated to store my customers' money. I can do better. So I think the customer-facing venues are asking this question more than the ultimate client. I think crypto is still like a B2C phenomena for pioneers or curious people. In the most immediate future, I think this will be abstracted away. Clients will still interact with a front end, an app, or whatever. It's just the back end will change completely, and the businesses that are client facing will decide, and they will decide they don't really want to run the risk, or bleed profits towards antiquated banks when they can use protocols or better rails to do so.
Right, and I guess that's kind of the MBA way to look at some of this stuff, which is, I guess if you think about the changes that have happened in banking with fintech and the neobanks, as you mentioned, the distribution sources and people who have the touch point with users are now things like Robinhood, SoFi, Wealthfront, down the list. And the banks are now the commoditized point in the stack. At the same time, I guess as a result of regulation and compliance requirements, it has been hard to kind of swap them out to some extent for the fintechs. And we may not be at a point where that can finally change, get better back-end infrastructure, and, in theory, pass more along to the end consumer of these products.
Yes, absolutely. I think we do not live in a vacuum. I think bankers, they understand very clearly that they need to lobby against a growing industry to emerge. They have been doing it. Now, especially in the US, the other side won. It was actually fascinating that for the first time, at least since I remember, you had Democrats being supported by Wall Street and Republicans being supported by tech. I think it's a sign of times. But I think your point is correct. Today, and I can state this and undersign it, there are way better, safer ways to store people's money than just putting it in a commercial bank. And this also means that there are way better ways to actually have businesses and people and protocols to interact with money digitally. And this is now is obvious, right? I think like the obsession today on cross-border payments, I think this is tip of the iceberg. Like cross-border payments really do not work. So digital money is perfect for it, and everybody is obsessed about it. It's true, but this is just the tip of the iceberg. Digitally native money, it's better across the board to do everything by definition. So I think you're right. Now, over the last 2, 3, 4 years, and most probably in the next few years, we really have the possibility to shift progressively mainstream financial intermediation from an analog bank-dominated one to a digital one?
Well, if I'm to think about the first kind of major experiment of digital money, and at least on Ethereum, I'd look at something like MakerDAO and DAI, where you obviously, that was maybe your first kind of crypto red pill, and also I think probably the first place that you worked crypto-wise and contributed your time to. That's maybe a whole hour-long conversation in itself, a lot of the work that you and the Love Group did for Maker. But I would love to kind of reflect on, on one level, what really motivated you to get involved in Maker. And then two, I think a lot of your themes around things like governance theater, token holder influence, like things that kind of inform what you're doing now probably came from that time. So yeah, I'd love to just kind of hear you reflect on the time you spent working with Maker and how that was.
Yeah, I'm always grateful of the time I spent part of the MakerDAO project, because I think it's no coincidence that I met so many great people as part of the project. Some of them are current business partners of mine, and others became friends along the years. I think you're one of those. I think that the project was differently from other crypto projects. There was like a very profound motivation of participants of the project that were really trying to contribute to like a good faith, life-changing experiment in finance compared to others. Across the board, right? It was from a design perspective, a usability perspective, or what DAI de facto was the first decentralized stablecoin in existence and reached to $10 billion. Imagine there are $10 billion of money floating around that doesn't have an issuer. It's actually just protocol led. But also, as always, things get very extreme from a governance perspective and a workforce coordination perspective, etc., up to the point that it became kind of ridiculous. But I think the origin of the original intentions of the project were absolutely healthy. For people who are not very familiar with the MakerDAO project, Maker is a protocol. To make it very simple, the protocol is not controlled or incubated by a company, but by a set of participants that do stuff for the protocol, and then there are governors, token holders, that can decide how the protocol can develop, how the protocol changes from a parametrical perspective, and how to pay the contributors. So it's really like a bit of a communal experiment. Now, I think that this was partially in good faith, partially in bad faith to do some sort of regulatory protection. But I think it's been very, very interesting over the years, up to the point where I think, and it's kind of understandable, it became impossible for the project to be managed in this decentralized manner. And some of the most relevant token holders and the founders of the project decided to go back taking control, which makes sense, right? What made a bit less sense is trying to go back taking control while still preserving this theater of decentralization, which was not true. And you were mentioning the LOVE experiment. LOVE is an acronym for Lending Oversight. It was a function that me and a few others were trying to champion in the DAO to make sure that we really had the proper checks and balances, to make sure that the protocol was not taking too much risk. Back in the day, everybody was trying to pitch to the protocol to get some sort of funding for their crappy lending assets, and we were trying to protect it. Kind of like dark heroes nobody remembers, but probably Maker wouldn't be here if we wouldn't have gated certain requests. But I think that at the time I tried to actually run like an activist campaign to make sure that the protocol was decentralized enough and the decision making was decentralized enough. I think it was still one of the largest activist campaign in DeFi ever, which was fun. fast forward few years, Maker is still thriving. It's still like a big project, has around $5 billion of liquidity, but has been changing a little bit, right? It became a bit less the central bank of DeFi that the protocol wanted to be at the very beginning, and became some sort of well-managed crypto native hedge fund that does other stuff with their money. I think is still a very interesting experiment and successful. But I had a different vision of the word, and I think I had different ambitions for the protocol. Before I just decided to step out and do it myself, and that was the beginning of the M0 journey, I guess.
Yeah, I want to use that to start talking about M0, but first I'm actually curious to go back to some of those credit deals and opportunities you were looking at as a part of Maker. That's how we first connected. I was working on TrueFi at the time. I think you had written about Goldfinch. And if we kind of fast forward, I can't really think of any credit protocol today that is thriving, that has kind of done that as their focus, as a kind of originator or marketplace of credit. I know Centrifuge had several deals with Maker. They were small, fortunately, but that have kind of gone under. Block Tower's deal is being wound down, the giant kind of car lending facility or whatever they were doing exactly. Obviously, treasuries as an RWA have seen incredible amounts of success, but what do you kind of attribute the state of RWAs to today, and how is that maybe different than how you thought about it during that time at Maker?
I believe things developed exactly as I was expecting, not because I'm a genius, simply because I had spent a fair amount of time in credit. Credit underwriting is very difficult. This is like an old story. It's very difficult to scale credit underwriting. There are very clear reasons why certain asset classes are not very liquid or not very big. I spend a lot of time in emerging markets, as you know. You can, like, I'm now having this podcast from Brazil. If you can run a very successful family office with $50 million of funding and fund specialty finance startups that are doing, small ticket consumer lending in Brazil, and you can get 20-25% return on your money if you're good. Now try to scale this to 5 billion and try to move to New York to do the underwriting of this 5 billion while the credit underwriting is still done in Brazil. You will absolutely be massacred. And I think that this is an old story. As soon as you make the value chain longer and you increase the distance between those who understand the risk and those who actually have skin in the game, bad things happen. And this is also the story of the financial crisis of 2008, 2009, right? You had an asset class which was mortgages. There were businesses born to just originate and distribute to investment banks. Investment banks were packaging it, levering them up, and selling them to pension funds. The pension funds do not have any clue what they're investing on. Cheap money flows in, bad credit comes in, and then the stuff blows up. So it's no surprise that most of those credits went under, because they are very difficult to underwrite. And you need to be a very sophisticated hedge fund credit manager to underwrite those, and not a protocol that is managed by a DAO of engineers, clearly. The story of the fact that treasuries have been dominating RWAs is also obvious, no coincidence, and I think it's a good evolution, because like for like, if you actually hold well a US treasury asset or USDC, you're better off with a treasury asset, because there is way less counterparty risk or overlay versus compared to USDC or USDT, for that matters. And with interest rates at 4 or 5%, they're profitable, right? If you're moving a lot of money. Maker at some point, I think, had $1 billion or more of treasury assets. This is $50 million of revenues for the protocol. So I think this is a good development. In my opinion, is you need to start with the easy things. So if you want to digest credit assets on a new technology stack, start with the easy stuff. treasuries are very easy. There is no inherent credit risk against the dollar. There is limited counterparty risk. You just need to structure them well, and then you can move up along the risk spectrum. So I think we went back to a more sustainable evolutionary path.
Yeah, I resonate with a lot of the things you said there. I think as someone who worked on this stuff but didn't have a credit background, it was very interesting to learn from credit people. Just, changing the rails that credit origination happens on does nothing to change the underlying risk of credit, which sounds very simple maybe when you say it, but I think was a lesson that was maybe lost in the kind of last cycle. And I am still curious to see what RWAs kind of beyond T-bills and stablecoins look like going forward. But sorry for another day, perhaps.
Yeah. There are some credit protocols that have morphed to do something else. I think Maple is a good example. I think the Maple protocol used to do under collateralized lending. That if you think back to like even the name of the category is crazy. Like you're doing a credit, like you're in the business of underwater credit. But in hindsight, everything is easy. But I have a lot of respect for the guys. The guys changed their profile, they morphed their protocol, they started doing something else, and now they're doing collateralized lending for institutions where you can actually measure the collateral, and most of the collateral exists on chain. So I think a lot of complex stuff will be done on chain. We just need to progressively bring on chain in non-custodial manner the collateral types. Everything is collateralized by something. Now you need to measure it. You measure this collateral. So even reputation is collateral. So the more you can bring collateral on chain in a measurable manner, the more creative you can be in structuring this into products.
Agreed. So coming back to just one last point you made on Maker there that you kind of got me thinking about was Maker feels like one of the rare projects, and I don't know the Rune and well enough to know this for sure, but it feels like one of the rare projects that started from a philosophical belief and then kind of built a protocol to, further that worldview, much more in the spirit of something like Bitcoin as compared to your sort of average shitcoin or something today. And when I think about M0, I think about it actually very much in the same way. At least, having some conversations with you along the way, it seems like you very much had a belief of how you thought these systems should work and formulated that belief and then built a project around that. I guess for our listeners as well, what is M0? And maybe if you want to kind of talk about your path to, co-founding the project as well, we'd love to hear that.
Yeah. And starting with Maker, I think you're right. For those who don't know, like Rune was one of the founders of the project, not the only one, probably not the most technical one, but is the person who stuck around and is still like leading the project. And I think it's not coincidence, because I think that one of the reasons why, in my opinion, and I have a lot of respect for Rune, even if we had our disagreements in the past. One of the reasons why he's still there is because I think Rune he has a deep technical understanding of architecture. However, he is very pragmatic and business-minded. So he can actually adapt the business that runs on the architecture. And he has been doing it a lot. And he's very good in playing politics, which I think is very important when you need to run an organization or a movement. And I think these are necessary traits to develop any successful project. And I can make many examples before getting to M0. Another example, like I think the Maple is another example. Morpho is another example. I have a lot of respect for the Morpho team. I've known them for quite a few years. They started as some sort of like compound optimizer, and then they absorbed an architecture that actually was not created by them. It was probably the invention of another protocol called RWAs to do like isolated lending markets. And they understood that this was compelling for the industry, and they have been developing along this direction, and they have been growing massively, and they have been extremely successful since then, because they are pragmatic and they know how to do business with people, and they are very smart from an architecture perspective. So I think the M0 journey is still early, although we crossed $100 million of non-incentivized liquidity, and we think this year we want to get to $1 billion. But I hope that the project has the same characteristics. So stepping back, what is M0? Where we think M0? How did it change in its 1.5 years of existence? And where do we want to go? So we founded, me, Greg, who also comes from Maker, and Oliver, who comes from a more traditional securitization background. We founded M0 2 years ago. We raised 2 very large rounds from very respected investors that we've known over the years. But we started M0 from the vision we had of what Maker could have become. So we wanted to create a protocol that was very similar to Maker in the sense of having a CDP-based model where you can pledge an asset and mint a token out of that asset that had good governance, which was not retail-oriented, but it was more institutional and informed, but also was designed to connect better to the world of traditional finance, so that the protocol could have digested better assets that were not existing on chain yet, starting from treasuries. So this was our belief. Our belief was like a very streamlined CDP-based stablecoin protocol with minimized governance that was not theatrical, and a protocol that was modular enough it could have developed with time. It would have avoided fractionalization of liquidity. So the protocol mints one token, and the token is the ultimate wholesale stablecoin. We don't really believe in a world with 1,000 different stablecoins. I think anyone who has been trying to spin out their own stablecoin, they understand that. Now, what is M0 today? I think back in the day, we thought that, okay, we're going to create this, and we have so many potential issuers that want to connect and pledge their assets to the protocol. And that's how we're going to grow. So we're going to grow from the supply side, not the demand side. And interestingly, this is what Maker thought at the very beginning. Maker said, okay, our business is very attractive for those who want to leverage their Bitcoin and ETH. We don't know who actually is going to ask for DAI. And the reality was actually flipped. Everybody wanted DAI. There was too much demand for DAI. There was not enough supply because people didn't want to leverage. I think the same thing happened in our first year of M0. We realized that actually it was still early for the pitch to be compelling to issuers who wanted to issue on the M0 stack by pledging their assets. But on the other side, the users of stablecoin assets, they were very interested, because the M token, which is the stablecoin proxy of M0, is hyper transparent by design, is digitally native. It can be programmed arbitrarily. It is yield bearing in its because the protocol streams yield. And these are traits that are very, very interesting for protocols that want to embed stablecoins in their stack. And so, like, if you look at M0 today and the way it is developing, we understood that we are focusing heavily on creating so-called extensions for protocols that want to embed their a stablecoin into their stack. So, like, if I make it very easy, people like institutions, so-called minters, can provide a proof of reserve that there is a good asset sitting somewhere. They can mint a subset of that in stablecoin form. So the stablecoin is always hyper-transparent and over-collateralized. This stablecoin is only one. There is no blacklisting functionality. It's credibly neutral. Nobody can rug pull you. Nobody can change the contracts. It's the best pristine asset you want. And then you can, at the downstream, if you're an application, you can program it for your own uses without breaking this fungibility across the network or liquidity. And this resonated a lot with projects. So we launched the first extension for Usual, the protocol. They needed a risk-free asset to actually back their use cases. They were already working with another issuer, which was a bit more Web 2.5, let's say. We created an extension for them where they have absolute control of blacklisting, whitelisting, freezing functionalities, any legal distribution they want to do. They get the vast majority of the yield that comes from the protocol, which is as close as possible to risk-free yield. And they don't fractionalize liquidity. What I mean is that if we want to go back to USDC, for example, they can unwrap their extension into the M token and swap into USDC through a permissionless AMM with a flash loan in one block. So they don't need to call BlackRock and just redeem their tokenized project and wait for the yield to come and then just go back to circle for their USDC, and it takes like 2 days. We have been doing the same for Noble. So Noble will launch their Noble Dollar on Cosmos, which is entirely backed by the M token. And we are thinking to do this for many other projects. And at some point, I think we will. I mean, I cannot share much on this, but I think we will be able to have a permissionless platform where people can build their stable coins on top of the M token, however they want. So that's very compelling, and I think that this is going back to Maker. The vision of what M0 is keeps evolving based on market feedback and where we think this the future is going. But I have and then I'll stop. I'm sure you have questions, but I have a fundamental view of where we're going, and I can state it very clearly, with the risk of being proven wrong. But I'm pretty confident about this, is that DeFi and most of the financial intermediation will happen on chain. DeFi will be the back end of fintech. The fintech of the future will be non-custodial. And even if now all the hype is around stablecoin projects that pretty much do on and off ramping between fiat and stablecoins, like Bridge, like many others, for me, the most interesting companies of the future will be on-chain stablecoin infrastructure projects. So projects that create infrastructure on-chain to do money manipulation on-chain in DeFi. And this is what M0 is. M0 wants to be the best on-chain stablecoin infrastructure project in the world by far.
Yeah, so I do have a lot of questions. And one piece that I want to dig into is the role of M, maybe less so being the asset that a user will interact with. And we can kind of come back to that because I know there are, Euler vaults and things like that, for example, where a user can. But thinking of M more as the kind of, correct me if I'm wrong, pristine yield-bearing collateral where other people can have their stable coins as just kind of like a branded version of M to some extent, right? If I think about Usual and Usual M today, that is the product that I suppose people will interact with, the Usual product, but that's backed and generating its yield from M, which has its own system of collateral management and SPVs and ensuring that all of the off-chain actions are aligned with what users think is happening on-chain. Is that a correct way to think about it?
Yes, I think it is. It is correct way to think about it. The way I would say simply is, I think M can be considered wholesale money. I think the best. It's very similar to what happens today in the banking world. So think about like you interact with commercial banks. Actually, the money you have is a commercial bank. Is printed by commercial banks, and commercial banks access a repo window behind the scenes with the central bank. And M wants to be that repo window on chain. So imagine at the center there is M protocol instead of there being a central bank, and instead of the commercial bank you have other protocols that create the customer facing version of it. but everything is fungible because everything has the same standard behind the scenes. And you said, yes, there are pools on Euler or other lending markets directly denominated in M. Users can interact with it. But in my vision of the world, personally, in the future, there will be applications will use lending markets, not retail. So I think that lending markets will be primitives for applications to build on top. In the same way, Morpho is currently integrated with Coinbase Wallet to do loans for their own clients. But I think this is a good way of describing what M is. I think M is a wholesale form of money that can be detailed, tailored by other apps or protocols without breaking the fungibility and the liquidity behind the scenes.
Yeah, I read an interview that your co-founder Greg gave where I don't know how you feel about this analogy, but I think he described you guys as kind of like a decentralized Paxos to some extent, where, they have this capability to issue stablecoins like BUSD in the past. And, you guys were playing a just much more efficient, entirely on-chain version of that, where you don't have to go through some 6-month negotiation to be able to launch the asset.
Yeah, I think this is it is a simplified way of describing it. I think that
yes.
what is not only that we are not a decentralized tech company, we are also like a decentralized tech company. But I think the fact that there is no liquidity fragmentation, it's very important. Like, you can go to Paxos tomorrow and they will give you the infrastructure to launch your own stablecoin, and then good luck, right? You need to create the liquidity network and the integrations for that stable in the ecosystem. Our model is slightly different. Like, you can build by connecting to a shared tech infrastructure that exists on chain to issue your stable. But this also means that you don't need to bootstrap the way this token is integrated across the ecosystem or the liquidity of the token, because you can piggyback on the liquidity and the integration of the token already. And this is a huge difference. Shared technological integration and liquidity is one of our core characteristics.
Makes a lot of sense. And, just kind of thinking out loud, we talked earlier about the NQA, no questions asked properties of money. How do you think about developing those properties for M? And, I guess a lot of that probably will come down to the fungibility and liquidity of these markets. So I see how some of these concepts are sort of interconnected as well.
The NQA-ness of money, I think I wrote a piece on Dirt Roads a few months ago, which to me is still one of the best ones I wrote, even if it was probably not one of the most popular, because I actually took inspiration from one of the best papers on money ever. I don't remember the author. I always forget the title, but it's about the weirdness of money markets. So good money is so robust that you really do not need to worry about. You don't need price discovery for money. If it's well designed, you shouldn't worry about what is in the balance sheet of a money issuer. That also means that good money is kind of capital inefficient, because you cannot push the boundaries of your asset liability management too much. And there is always this attrition between users of money and producers of money. Producers of money want to put as much risk as possible in the assets backing, in the collateral. And users of money, they don't want to be bothered. They just need something that works and can be trusted. And there is always tension. How are we doing this for M0? I think at the very beginning, we are starting by obsessing with the quality of reserving and the quality of the assets. Currently, if you go on dashboard.m0.org, you can see at the single QSIP level what instruments are backing the money supply. And every day, the issuers, the minters, they need to have external validators signing the reserves. So you have an on-chain daily attestation of the reserves for the protocol. This is step one, right? I think we spent a lot of time designing the structuring that is custodying the reserves. We published non-pop guidance on this, and I think so hyper transparency is our first step. We really want to make sure that to push the highest standards possible at the collateral level to ensure that the holders of the M token or the builders on top of the M tokens, they don't need to worry about the quality of the collateral. And unfortunately, most people do not care about this. They care when it's too late. But we really want to make sure that we will be there when other projects will go down, because I think surviving cycles, it is the best advertising you can have. And I think that we will develop along those lines in just being very conservative, very transparent, and very, very professional in the reserve management and guidelines on how M can be created, stored, and how it can evolve. So to be more pragmatic is now we have a long list of so-called tokenized instruments that you can use as assets on chain. They're all different. Some of them are real, some of them are not real, some of them are custodial, non-custodial. There is a different risk. I think the M token, for those who embed the M token inside their workflows, being apps, fintech apps, or protocols, they need to be in a position where they know that the instruments, the protocols, the structures that are behind the creation of this M token, that are doing the collateral reserve management, are the highest quality possible in the industry. And I think that's what they need to be sure of. So obsessive quality controls in evolving how M is created from an asset collateral perspective is our North Star.
Yeah, two follow-up questions there. One is on the collateral management piece. That today is done by one collateral manager, or I guess it's not the case that each new stablecoin issuer has their own collateral manager, because it's, they're minting a fungible token with M. So have you guys shared or talked about who actually does the collateral management today?
Yeah, so first of all, our system is many-to-many. So you think about, you can have a minter, which is the issuer of record, a collateral manager, and a custodian. These need to be separate entities, and you can compose those however you want. You can have a minter using two collateral managers. You can have a minter developing its own. You can have one collateral manager serving more than one minter, etc. But what is important for us is that there needs to be separation between ownership and control of the collateral. And this doesn't happen actually for most issuers. Most issuers, they have a balance sheet, they issue a token, they promise you that they will keep the value of that token in their assets, and you need to trust them. Sometimes you need to trust the regulator. So we actually want to create a many-to-many network that separates ownership and control. And the contracts that are linking those parties, they need to be institutional in nature. And this is nothing new, right? If you look at securitization markets, you have those that do the tranching and sell the notes. You have those that manage the replenishment of the assets behind the scenes. And the custodians, these are separate parties. And this is a big market. Like the RMBS, the CMBS market is massive. So we are learning from financial history. So currently, there is one issuer on the M0 network, is a BVI issuer called MXON. They have one collateral manager, which is called Crossland. It is an asset manager in Luxembourg, as many other asset managers for securitization in Europe. And the custodian is Deca Bank, which is a German globally systemic bank, which is actually storing the asset. So the issuer, MXON, cannot grab the assets in the reserves unless they provide a proof to the collateral manager that a proportional amount of M has been burned with the protocol, so to free the asset. We are working with a couple of other issuers in other jurisdictions, and those issuers, they need to comply with the same standards. They need to have the same segregation. Funnily enough, if you go to Europe or even to the US until now, they tell you, yeah, no, you cannot actually. We didn't go to the US because the US were telling us, yeah, you cannot actually have separation of assets, control and property of the reserves that is backing a stablecoin. Actually, you need to put everything in a bank, and a bank, you need to run the risk of the bank. And we don't want our holders to run the risk of a custody bank, because Circle Circle still exists today because for some reason the US bailed SVB. If SVB wouldn't have been bailed, Circle would have been destroyed. And so they missed a bullet, they dodged a bullet there. We don't want to be in that position. But I think the regulatory landscape is changing and is becoming less protective of banks and more open to discuss what is actually good for the holders. So we hope this year to expand the network of issuers in different jurisdictions, and the issuers, they need to follow the same type of standards. So they may use the collateral manager that we bootstrapped in Luxembourg. They may use their own. They may use another custodian, as long as the quality standards are the same.
Got it. So basically, more separation on kind of the behind the scenes stuff to give higher assurances to the end users. My other follow up question I was going to ask there was sort of a basic one of, if you ever viewed a future where if T-bill rates get so low, would you consider bringing on other, not the collateral managers, but the minters or issuers to kind of do other things, whether that's lending or other ways to generate yield. But as you were talking, one thing that kind of came to mind for me is that maybe it's not the case that the higher yielding activity needs to exactly take place at that layer of the stack, but maybe one level higher, where if it's Noble that ultimately has the end relationship with the user and is minting the M, they can choose to do something higher yielding with that, whether it's credit, whether it's a DeFi protocol, lending it, borrowing against it, looping it, whatever that might be. And that's actually the place where the higher yielding activities can take place, right? That layer between the end user, USDN or whatever, and where you guys sit at the collateral level. Is that kind of like SFRAX to some extent? Is that a good framing or?
Yes, absolutely. I think the beauty of DeFi is in allowing composability. Now, we call them M0 for a few reasons. Because we thought that, first of all, if you look at the logo M0, M power 0, anything power 0 equals 1. So we wanted to give a sense of stability. But also, we thought that M0 could have been the base layer for other financial use cases to be built on top. Because M0, if you know a bit of monetary policy, you know that M0 is the narrowest definition of money, right? I mean, M0 is really central bank reserves and outstanding cash. Now, the money we have in bank accounts is not M0. I think bank deposits, if I'm not wrong, they are in M1 or M2 definition, depending on how they are structured. So we want to keep M0 reserving policy as close as possible to the reserving policy of a central bank. So if the central bank includes Bitcoin at 5% into the reserving policy, why not including Bitcoin into the reserving policy of M0? But if we had to create another layer that adds credit risk and credit creation, we will probably do it on top of M0. We will probably create another protocol. I think M1 is the best name for this new protocol. But exactly as you suggest, we think this type of risk increment should be done at higher level of the stack.
Yeah, and that I think I'm seeing the fuller picture now. Where I also understand now why it's very important to start to have some lending markets and more use cases against M directly, even if that is probably not how many users will ultimately earn yield from the product. Maybe they're holding USDN, but if USDN decides that they want to earn above T-bills by lending on Morpho or something, or Euler or something of that nature, all those integrations need to exist, essentially. Very cool. Okay, I feel like I've got a better picture of the product there as well. So, one other thing that I guess as we're kind of talking about go-to-market is you've had some success so far with Usual and Noble. And what's the pitch when you go to one of these people who already have a stablecoin and want more backing, or are interested in issuing a stablecoin? How's that gone so far?
I think it depends. I think if you look at our new website, we are talking to more than one audience. Some are like some parties are interested in more in one thing, or others in other things. But let's look at other protocols or other developers. I think our pitch, which is the pitch we had for the integrations we have built so far, which are very early days. We are very bullish about the TVL that can flow through those integrations by the until the end of the year. Our pitch is that the M token is the best proxy of risk-free rate on chain, is the safest proxy of what the risk-free yield is on chain. It is the most transparent. It is the most programmable. It is the most crypto native. And I can make many examples, but you can actually manipulate the yield coming from the M token in ways that you cannot do with others, because we have created a protocol around it. So the yield, I make an example, like we launched, actually if you go in DeFi, wrapped M is the main asset you interact with, not M. Wrapped M is a way, it's always one-to-one against the other dollar proxies. You can decide where the yield underlying goes. So you can actually have it on Uniswap, and you are not bleeding yield because you can redirect the yield in other places. You can decide programmatically on chain how to distribute the yield if you have a family of wallets. Imagine a world where Workcoin is actually building their own stablecoin on top of M, and they can decide on chain programmatically at the single word ID level who is actually getting yield and why, and based on which actions, without any contract, etc. So that's the pitch for us, I think. And the M token is the safest, best proxy of on-chain risk-free yield, the most programmable, the most integratable there is. So there is so much stuff you can do on top. Whatever you want to create, if you want risk-free yield to be embedded within your use cases, whatever it is, M is the best solution for you to do so. And as we scale and we become more liquid, as you were suggesting, this value prop is going to be way more and more relevant, up to the point that it's actually becoming relevant also for builders that exist outside of crypto, and they're starting to build on stablecoin rails their consumer applications.
Yeah, I think we can go. I'm curious to talk about some of those fintech relationships as well, but something I want to come to before I forget is you've also written a lot about the economics of stablecoin issuers, right? I think everyone listening to this is aware that Tether is this incredible business, and actually I think Bitfinex is getting back like 100,000 BTC from that hack, so they're even more assets for them. Circle is a pretty good business, more compliance costs. I think other things drag them down, but makes a lot of money. MakerDAO is, for DeFi at least, an excellent business. They pay out a lot of otherwise profits to things like SDI and now SUSDS. But stablecoin issuer economics are very interesting. And I think something that stands out to me in the stack that you're laying out here is that compared to others, there are more players here. There are all of the managers and custodians of the assets. There's M, the protocol itself. There is the Noble or other examples like that. And then the end users who may be getting paid yield as well. How do you think about the economics breakdown of M0 today?
Yeah. So we have created a protocol that really has the ability to dynamically distribute the upside, the economics, depending on what are the priorities of the protocol. Right? Obviously, priorities change if you need to push adoption, or if you need to protect your market share, or you are in a position to do some seniorage. I think we have created a protocol that allows moving this upside. So I think, first of all, I don't think there are more players. I think that if you have a custodian, if you have a collateral manager, you're simply externalizing. You have service providers instead of doing this in-house, and this is quite standard. But I think that you have the user at the very end, so the holder of the token at the very end, the individual holder of the token. You have the assets at the opposite side. So if the assets are yielding 5%, the maximum you can push downstream for the same risk, ignoring attrition costs, is 5%. Now, we had last year a lot of projects coming with the idea of creating yield-bearing stablecoins, where the entirety of this 5% yield was distributed down to the individual user. Now, this is a contradiction in terms, because the banking model is actually created with the belief that you can actually have a spread between what is the asset, the yield on your asset, and what is the money you need to pay to the liability holders, the retail, to actually park their money with you. Like, no one gets 5% yield on their current accounts ever, and we still have money in current accounts because we need it to pay. And I think this is where banks make most of the money. It's the spread between the asset yield and the average cost of liabilities. So why would you need to give all? You should give all that upside to the holders who are not really sensitive. They don't care. And that's why we have seen this, like, there's yield-bearing stable coins that have struggled to gain market share, because people care more about utility and liquidity. So with the M protocol, we can move the economics across the stack. Like, there are three main levers how we can do this, how we can do monetary policy. The M protocol charges a rate, a so-called minter rate, to the minter to mint. So let's say that you have $100 million of treasuries sitting in a vault. You can mint a subset of that, let's say 98%, for example. So you can mint up to $98 of M. You need to pay a minter rate to the protocol to mint. Now, if you're charging the minter rate to be as high as possible, so as close as possible to the asset yield, what you're ultimately saying is that you're not leaving any margin to the minter. The minter is just like, to mint, they are paying something that is very similar to the asset yield. So most of the asset yield is going to the protocol. On the other side, the protocol has an earner rate mechanism. And the protocol decides how much of that yield is distributed to the earners. Earners are not retail, but let's say distributors and other protocols that actually build on top of them. So in the scenario where we are now, actually we are charging the maximum to the minters, to one minter, extracting most of this asset yield, and we are pushing as much as possible to the earners. So the earners are getting most of the economics, because we really want to integrate earners. Now, with time, you can have some of the float which is not earning, because they are just adopting M because it makes sense for utility perspective. They're less sensitive to earning. Or you can actually create a spread between the earner rate and the minter rate and have some spread for the protocol. So you can be in a scenario where half of the float is not earning because it's sitting on, I don't know, retail wallets and they don't care. So you can actually pay double the risk-free rate to the integrators and still be collateralized. Or you can be in a position where you think that the protocol is so powerful that can create a spread of certain basis points between the earners and the minters. So you can see, like, we created all the monetary levers to move this the yield and the upside depending on where we want to go. In my opinion, obviously Tether is the most successful business in the history of humanity. By definition, it's not sustainable. When you have 100% margin, that margin will be compressed. My dream for M0 is that M0 will have hundreds of billions of dollars of float and single-digit margin, or like very low margins in terms of basis points. So I don't think we are trying to create a business that has 20% margin on $1 billion, like an asset management product, like a hedge fund product. We want to create a network that has $1 trillion and 5 basis points of margin for protocol holders, for protocol and token holders. But we built all the levers to give us flexibility to move this, the yield based on whom we want to attract on the network.
Yeah, and I think that is probably the most powerful piece there, just the ability to move those around. And I think, as you talked about as well, right, we'll have different cycles where, people do expect a higher yield from some of these asset issuers, or they're okay with a lower yield because of what they're able to do with it, what they're able to do with the asset ultimately. And I guess you're correct. I hadn't thought about that as much, but, if I think about a team that I very much like and respect, like Mountain, for example, Mountain Protocol, which does have one of these yield-bearing kind of stablecoin products, their biggest period of growth was while they were included as a collateral asset for one of these bridges. I forget actually what layer 2 it was, but it was where it was just this kind of back-end middleware to generate yield for people, but not that the users were actually holding that asset as their primary sort of yield-generating activity, not like their checking account with a yield, essentially. So I agree with that framing very, very much. Okay, you also talk about kind of the governance system and the actual token of M0 as well. I think one of the interesting aspects that I've read about, but I'm actually maybe the least familiar with of M0, is the kind of 2-token model that you guys are working on. One which has, I guess you could say, the economic rights, and one which has the governance rights. You can tell me if that's the wrong separation, but tell me about that, where the idea came from, and how that's working thus far.
Yeah, so it is correct. The description at a high level is correct. I think that this was like Greg's baby. We all contributed, of course, but he was the champion of the idea. But this came from our experience in like the early days, crypto governance, of course, where there was this token, the so-called governance token, that at the same time was having sometimes some sort of economic rights, governance rights, and was also considered as a proxy for the success of the token, of the project. I think if you are a value investor, you look at some of the governance tokens these days, they have no connection whatsoever with the economics of the protocol. They're just meme coins for the protocols, pretty much. Not all of them, of course, but some. And I think this created weird situations where actually nobody was really participating in governance. Holders were buying those tokens to speculate on the success or the visibility of the project. Most of those tokens were sitting in centralized exchanges or were staked as collateral for other protocols. These created very bad incentives where you had sometimes one party with 5% of the token float deciding the destiny of entire protocols. And this was pretty bad. And I think that, again, we're learning from traditional finance and from the shareholder model. Like, you have different class of shares, and there are people taking decisions about where the business should go, and others that simply want to get some rights to the economics of the project. I mean, TradFi doesn't have meme coins. Sometimes it does have meme coins as well, but it's less of a phenomenon. So that's how we design the protocol. I think the protocol that also our CTO Antonina, who spent quite a significant amount of time in Compound, which is like a crypto governance granddaddy, has two tokens, a power token and a zero token. The power token is not an ERC20 token, has traditional standard governance rights. Governance for us is very basic. You need to decide which party can connect to the protocol to do stuff and how to move the parameters. But you have zero decision-making power on how to use the treasury of the protocol. I'll get there in a second. Now, the power token forces the holders to vote. If they don't vote, the protocol inflates every epoch, every month, the power supply by 10% and auctions off permissionlessly these tokens in the open market. So if someone cannot really participate in governance, they will progressively see a very steep dilution in their controlling power, and other parties will come. That means that people are really incentivized to vote. So we distributed the power tokens to our investors and the team, and we have 95, 98, 100% participation every epoch, because people get punished if they do not participate. On the other side, the zero token holders have economic rights over the protocol's economics, as you suggested. So like whatever dollar, whatever M token is captured by the protocol from the minters and not distributed out to earners, and in a smart contract that we call a distribution vault. We do not have a DAO can access this, but zero token holders, they can sweep this vault on an epoch by epoch basis with a percentage of their token. So if you have 10% of the zero supply and there is $1 million in the distribution vault, you can sweep $100,000 in M form for yourself. And this is an ERC20 token. We think this is the best representation of the financial success of the project. And there is a complete separation between traditional governance rights and economic rights. But apart from an exception, in case there is an emergency, or in case the zero holders, the economic holders, they don't like power token holders and they want to fire the managerial class, at a higher quorum, they can. So they can reset the power distribution and redistribute the power tokens to themselves proportionally. So that if power token holders do not do a good job to protect the economic holders of the protocol, they can be kicked out.
Interesting. Yeah, that was one of my questions. Are there scenarios you envision where power and zero holders would conflict, perhaps in their interests? But I guess there's some provisions for that baked in. One question that does come up, though, is, will the protocol itself have some, because you mentioned you won't have a DAO, but so how will the protocol sort of fund itself? If not, or will it have some percentage of zero to be able to kind of continuously fund operations, or how do you envision that?
Yeah. So two sides here. First of all, like the M0 Labs, which is the company that built the M0 protocol, which is permissionless, ossified, and exists on mainnet, raised a significant amount of money. I think we raised roughly $60 million of equity in 2 rounds. One was led by Pantera Capital. The other one was led by Bain Capital. So in my opinion, we have one of the very, very best cap tables there is. Long-term investors, crypto savvy, fintech connoisseurs, market makers. So we are using this money to bootstrap the liquidity of the protocol and to keep building additional features for M around the M0 protocol itself. So this is a big component of it. I think no successful project is profitable for a very long time. Most tech companies, they keep burning cash for a very long time because they keep building and expanding. At the same time, when we did the distribution of the tokens in our token generation event, now zero and power token holders are not traded in any exchange. I do not think they would be traded anytime soon, but exist because they are required to operate the protocol. when we distributed the tokens, we distributed roughly a 20-something% of those tokens to an M0 foundation in Switzerland. So the M0 foundation has 20% of the token supply. Some of it might be sold in the future in exchange for cash that can be used to keep fostering the ecosystem. And obviously, this also means that the M0 foundation has some residual rights to the economics of the protocol. Now, the M0 foundation also, like, even if it has a significant amount of power supply, always remains neutral to any vote. So if you see any vote on governance.m0.org, you will see that the foundation splits programmatically its power supply 50% for yes and 50% for no in any decision. So remains neutral. But yes, the M0 foundation, we think, will be a central, as for many other projects, will be a central player for the development of the ecosystem.
Makes sense. Yeah, and that's a fairly common structure, I believe. So coming back around to one of the, I guess, bigger topics you've both written about and we've talked about a few times today. I have to write this one down because it wasn't a term I was familiar with, but you've described crypto monetary infrastructure as being in its 56K modem era. And we're also talking a bit today about some of these fintech integrations, the Morpho one that you mentioned and, other ones that I think you guys are working on. Actually, we're working on with Vaults FYI as well, and sort of our API stack for connecting to all of these protocols. And I guess I'm curious, are these fintech integrations kind of the real world integrations you imagine getting us past this 56K modem era, or is there something else there also that you think will kind of get us to this next level as an industry?
I think that it will take some time. I think we are starting to see fintechs using stablecoins in the middle of their value stack. Yeah. For example, for cross-border payments, they on-ramp cash into stables, they move the stable somewhere else to another wallet, and then they off-ramp this cash into another bank account. This is really an unsophisticated way of using stablecoins, but very powerful because the use case is big. But I think that most of the fintechs that are currently using stablecoins are payment players. So they just need to move money around at relatively low costs, and they do not manage clients' funds, or they don't do anything more sophisticated with that. But I think I am absolutely convinced this is early days. I think in the next few years, those players will try to become crypto-backed neobanks. You will start seeing some exchanges trying to expand the spectrum of financial services they provide to their clients in a non-custodial manner, in the same way that Coinbase is doing through their wallet. So we will see the convergence of fintech neobanks, exchanges, e-commerce players, etc., just to provide a longer list of services to their clients. And I think those services will be non-custodial, and most of the action will continue to exist on chain. So I think, yes, we will still have this on-ramping, off-ramping phenomenon because people will, we are still using cash in the world. So I guess we will keep using bank deposits for a very long time. But I think that in the next iteration, we will see progressively more and more and more wealth staying on chain and being manipulated on chain. And I think this is where we will move from 56K to whatever speed we can do depending on the infrastructure. I always joke that we are in this situation where we have digital photography. We take pictures with our camera, we scan the pictures with our scanner, and then we manipulate them on Photoshop, or we store them, or we send them to someone via email. We are not yet in the position where we take pictures directly with a camera, with a digital camera, or with our phones, and those pictures already exist digitally, and we never print them. At the beginning, we say, yeah, I'm gonna take I'm buying a digital camera so that I can take many pictures and I can print the pictures I like. And then fast forward 10 years, we don't have printed pictures. I have one printed picture from my wedding. We always joke with my wife, just one. We have thousands on our Google Drive. So I think this is going to be the same. I think that in the future you will have crypto native, on-chain native financial intermediation, stablecoin rails that are facilitating value movement and value that will remain more and more and more on chain.
Yeah, I mean, I don't know that it's the best example, but I suppose the place we kind of see that today are apps like Moonshot and these things that really abstract away the fact that you're doing anything on chain, but you clearly are. I hope we can maybe have more sophisticated use cases, but hey, who am I to judge? Well, as we're coming to the end here, I'd like to know, I think for readers of Dirt Roads, something that you're very good at is talking a bit about the future, both in positive and sort of negative terms. I think you've had a good radar for identifying things that may blow up or writing about them in those timeframes. So I'm curious, both outside of what you were doing, so no M0 related answers, what today in DeFi has you most excited, and perhaps what has you most concerned or nervous as well?
Okay, let's start from the positive. Unfortunately, I don't have as much time as I had in the past to keep researching and writing, but I still do. Keeps me alive. I think I wrote in the past. I think a couple of things I mentioned now and a few things I've written in the past about is some primitives that can be facilitated by on-chain rails are really fascinating me, like prediction markets, for example. I think I spent some time thinking about prediction markets as part of the election rush. I think this is philosophically is a very, very interesting phenomenon. I mean, it's not about betting, it's about incorporating on-chain different sources of risk on which you can create financial products. I think this can be abstracted to insurance, for example, or other forms of value intermediation. And also what excites me a lot is the integration of DeFi with non-custodial front ends. I mentioned the Morpho integration with Coinbase. I think this is a great example. I think we will see more of this. The fact that now we have a regulatory landscape that allows us to do good faith innovation without the risk of going to jail simply because we are trying to invent new things is going to be very conducive. But I think that this integration between DeFi primitives and fintech front ends is exciting me a lot. On the negative side is I do not believe in getting rich quick. I do not believe in claims. I do not believe in tourists coming. The fact that there are so many fintech influencers coming to talk about stablecoins without a clue about what they're talking about smells of bubble to me. Not great. The fact that we have meme coins freely flowing and being issued is not great. The fact that we are putting additional leverage, operating and financial leverage into the system is not great either. So I don't like greed. I think it's destructive for good faith builders. And I think quite a few people are going to get hurt in the next 12 months across. I mean, I don't know. I cannot point my finger, but I think people that are building leverage or they are buying above fair market price certain things, they're going to lose money. So this keeps me nervous. It is not a new phenomenon. When the hype when the little bubbles will explode and the hype will come down, we will still be here building stuff. So I created my own personal brand in trying to be first principle oriented through the cycle. Some people remember, others don't, but I think I'll still be here. But this is, I mean, I think we are going from a situation of excessive regulation where everybody should be sent to jail to one when there is no regulation and there is no really securities law and there is no way to control how retail can gamble their money on chain. Both extremes are bad for business.
Yeah, it's going to be an interesting 4 years, that's for sure. And I guess, just have to ask, all the hype around stablecoins. I mean, have you guys felt anything different in the people that want to work with you or reach out to you? I mean, obviously the Bridge acquisition, I think, was the big catalyst for everyone to kind of wake up. And it seems like every day I see a new, fintech app or neobank or a crypto app, I should say, that's like doing cross-border with stablecoins. I know there's a stablecoin conference that just got launched. I saw you're speaking. I actually applied to speak as well, so we'll see. But obviously people care about stablecoins. But where is the critical risk there that you think could emerge? Or
I think this is more positive than negative.
Okay.
I think that a lot of people are more open to consider stablecoins legitimate financial instruments and not conduits for money laundering or stuff like that. I think what has changed massively is that the US is open for business, so you can actually interact with US players or think about doing business in the US, which is something that any lawyer would have advised against 6 months ago, which is great. I think it is going to be great for fundraising for certain projects, but at the same time, there is also going to be a lot more noise, and noise can also be distracting. But I think that the builders, the stablecoin builders, have been around for many years. The serious ones, we all know each other. I put myself in the mix. The high quality investors that have been able to separate the signal from the noise are always the same. And I think these guys are operating the same way. I think that anyone, any knowledgeable investor in fintech and crypto has known for a long time that we are in a moment of transformation where we will digitize bank deposits on crypto rails. This is just the beginning. The cross-border, most of those newcomers into the stablecoin arena are obsessing themselves with cross-border payments. To me, cross-border payments is really like the 0.1% of what we're talking about. We're just we transform cash into bank deposits in the 20th century. Now we are transforming bank deposits into stablecoins. We will have 20 to 50 years to build. So I think that if you have a high conviction and you're a serious builder, you were excited before, you're excited now, nothing changes. I mean, we raised our seed round, which was the largest seed round back in the day. We raised almost $25 million in the middle of the FTX blow up. The serious investors, they still had high conviction on stables. We raised our Series A with Bain before Bridge and Stripe were even talking. Nothing has changed. We were significantly oversubscribed then. I hope we will be significantly oversubscribed for our next round. I think there is so much to build. But overall, it's positive. I think that finally people are considering stables not as tools for money laundering, but serious alternatives to other financial primitives. But it's so early. I think people are still missing the big picture here.
I couldn't agree more, and that's a much more positive note to end on. So, Luca, for anyone that wants to get involved with M0, how can they? Can they get involved in governance today? Are there markets they should check out? How can they get involved?
Yeah, first of all, you guys can find us on social media as usual, on Twitter, M0 at M0 Foundation, at Luca Prosperi is my Twitter handle, or X. Actually, you can read my stuff on Dirt Roads as you suggested. We have a brand new website at m0.org where you can contact the team. For builders, we keep expanding the team on the engineering side, on the business and legal side as well. And I think we will keep expanding for a while. In terms of DeFi interactions, we exist in DeFi, even directly. You can actually trade M for USDC on Uniswap. You can use M as collateral on Euler. Soon you will do it in other on other lending markets. We will soon launch on other chains for people to interact with them, and we will build more and more extensions that are client facing backed by YAM. So there are many ways you can interact with us. And obviously, if you're a builder and you're thinking that you want to embed stablecoins or risk-free yield into your stack, if you're an exchange or a perp exchange on chain or some sort of protocol that has money flowing through, you should obviously get in touch. So hopefully many will reach out. I think we are progressively getting out of stealth. We're not good with hype, but I think we will run a couple of large marketing campaigns this year to show to the world what we're doing.
Awesome. Luca, well, thank you for all the time today. I always enjoy talking to you. I always feel like I learned something from talking to you, from reading your stuff. So a pleasure. And if anyone wants to learn how to earn on and with M, you can also go to vaults.fyi, and we definitely have the Euler vaults on there. So, all right. Thank you, and talk soon.